Good morning, everyone, and welcome to our webinar, Smart Decisions You Can Make for Your Wealth. I'm Seb, a Senior Wealth Manager here at JP Morgan Personal Investing, and I'm joined by my colleague, Stephen, another Senior Wealth Manager here. We're delighted you have joined us today. Our goal is to help you make more informed investment decisions, and today we're focusing on what you can do to maximize your tax efficiency using the different allowances available, both before the end of this tax year on the 5th of April and into the new one. Managing your wealth can feel complicated, but with the right strategies, you can keep more of any returns and make confident decisions for your future. We do need to cover off some housekeeping, though, before we begin. When investing, remember that the value of your portfolio can go down or up, and you may get back less than what you invest. We will be talking about tax, and the tax rules that apply to you depend on your individual status. These are the rules that are in place as of now, and they may change in the future. What we'll be discussing today is general information, not personalized tax advice, and you'll need to consult a tax specialist for that. We'll also talk about tax efficient products, which each have their own rules about how they work and who can use them.
Thanks, Seb. Okay, so let's take a look at what we'll be covering today. So firstly, what we wanted to do is talk about why tax efficiency is so important and how making tax efficient choices can help build more wealth for you. Next, after that, we'll break down the annual allowances available to UK investors, such as ISAs, pensions, and gifting, and we'll explain how they work. We'll then walk through 3 possible scenarios, showing you how different people might use these allowances to help reach their goals. After that, we wanted to share some practical steps you can take right now and how we can help you implement them. Finally, what we wanted to do is open the floor for your questions, but if you do have any throughout the webinar, feel free to post them in the Q&A box. Please do remember that today's session is for general information only, but if you would like to discuss your own situation, you can scan the QR codes on screen throughout the webinar to book a free call with one of our experts.
Thanks, Stephen. So let's start with the basics. Why does tax efficiency matter? Well, for every pound you protect from tax is a pound you can save or invest for the future. And by doing that in certain ways, you can keep even more pounds in your pocket. This is what we mean when we say tax efficient. Whether you're planning for retirement, buying a home, or simply growing your wealth, tax efficiency helps you reach your goals faster. With a variety of allowances on offer, there are plenty of opportunities to take advantage of. The exact allowances available to you will depend on your individual circumstances. Please ask us during the Q&A at the end if you're unsure, or just book a call with one of our experts for a more in-depth discussion on what you could take advantage of. If you are a higher earner, using your allowances provides further advantages on top of those related to maximizing your allowances. So, for example, restoring your personal tax-free allowance. If you have children, an added benefit of lowering your income to £100,000 or less is that you may now be eligible for tax-free childcare in the 30 hours funded childcare scheme. We'll go into this in more detail shortly. The UK tax year ends on the 5th of April, and that's a key deadline. By acting before then, you can use your available allowances to shield both income and capital gains from unnecessary tax. If you don't use your allowances before the deadline, some of them are lost for good, and you could end up paying more tax than you need to. So now's a great time to consider if you can use more of this year's allowances before they reset.
Okay, so now we'll go through some of the allowances that you can use to be more tax efficient. So you might have heard of a stocks and shares ISA, and this is a government product which allows you to invest up to £20,000 per year with any returns, growth, and income tax-free in the UK. Now, a lifetime ISA or a LISA is a product which allows you to invest up to £4,000, which is part of your broader £20,000 ISA allowance per year with an added 25% government bonus. So this essentially adds up to £1,000 in additional contributions on top of what you pay in for free, essentially. This is designed specifically for first-time buyers or for those saving for retirement. And you can open a lifetime ISA until you turn 40, contribute to it until you turn 50, and withdraw when you turn 60. Given that it's an ISA, it'll also be sheltered from tax in the UK. Now, in addition to your own allowances, you can also invest up to £9,000 a year per child into a junior ISA, helping you build a nest egg for your children's future. They can only access the funds when they turn 18, and it can be a great way to protect some more of your money from tax if you've already used up your own allowances. When it comes to the pension, you can contribute up to £60,000 per year or up to your relevant earnings, whichever is the lower of the two, and you can get tax relief at your marginal rate. There's a capital gains tax exemption, which can allow you to realize £3,000 in gains per year without paying tax. There's also a personal savings allowance. And if you're a basic rate taxpayer, you can earn up to £1,000 in interest from savings tax each year. This drops to £500 if you're a higher rate taxpayer, and there's no allowance for additional rate taxpayers earning over £125,140. You can also gift up to a total of £3,000 per year, and you can also use special allowances for weddings and other occasions to pass on wealth without incurring inheritance tax. But one note on this would be is that rules around inheritance tax can be a little bit complex, so we do recommend getting special advice on this. Another thing that you should really consider on this is that if you have a spouse or a partner, your household essentially has two sets of these allowances available. So this could make it even more tax efficient from your perspective. And finally, I'd just like to say, and just for you to remember that, how you use these allowances does depend on your life stage and where your goals are. So what we wanted to do is just look at a couple of examples to see how they can work in practice now.
Thanks, Stephen. So over the next few slides, we're going to walk through three different scenarios. Each one shows how someone with specific goals can use their allowances to be more tax efficient and potentially reach those goals sooner. You might not see your exact situation, but hopefully you'll spot a few strategies that could work for you. And remember, if you do want to discuss your own circumstances, please do feel free to book a call with us and speak to one of our experts.
Okay, so in our first scenario, we have Anjali. She's in her early 30s. She's saving for her first home, and she's using a mix of current and savings accounts. She's earning a great salary. She's building her wealth, and she wants to do all she can to maximize her money and enjoy her opportunities. For example, she wants to tick a few destinations off her bucket list. She also wants to buy her first home and have enough wealth to set it up properly as well. She's not maximizing her ISA allowances, but she's been saving as much as possible. As she has about £25,000 in savings, the interest she's earning has reached the £500 allowance, meaning she's now starting to pay tax on it. First of all, Anjali could set up a lifetime ISA. This could protect more of her money from tax, give her a better chance of achieving her goal of being a homeowner, or allow her to supplement her retirement after she turns 60. By paying in £4,000 per year, she can get the maximum £1,000 government bonus. And with a stocks and shares lifetime ISA, she can also benefit from tax-free growth. After paying the max into an ISA, Anjali will have £16,000 of her ISA allowance left, so she could consider paying more into a stocks and shares ISA. This could give her money a better chance at growth to achieve her travel goals, although investments can go up and down, but it can also protect more of her money from tax. With a £105,000 salary, Anjali is currently within what's known as the 60% tax trap. Basically, if you're a basic rate taxpayer, you're entitled to £12,570 personal allowance, which is the amount of income you can receive each year without paying income tax. Once your income is £100,000 or more, the personal allowance slowly tapers down at a rate of £1 for every £2 of income above £100,000. In real terms, this means that for every £100 of income between £100,000 and £125,140, £40 is deducted in income tax, while another £20 is lost by the tapering of personal allowance. What this results in is an effective marginal rate of 60%. To get out of this tax trap and keep more of her money, Anjali could pay more to a workplace pension or a personal pension, or a combination of both, to reduce her income below £100,000. This has the bonus of using some of her £60,000 pension allowance, while also investing with tax-free returns for her future too. This combination could help her build wealth for both short-term and long-term goals, while also reducing the tax she pays along the way in doing so.
Great. So now let's look at Marco. Now he's a high earner. He's earning £133,000, an annual bonus. He currently maximizes his own and his partner's ISA each year. He has two young children, so life is a busy balance, and he wants to make sure he's doing all he can to build wealth for their future. He also wants to keep more of his money aside for important family milestones. Marco needs to pay nursery fees, but with his high salary, he currently isn't entitled to the 30 hours free childcare. Marco could potentially pay more into his workplace pension to reduce his income below the £100,000 threshold. That way, he and his wife may indeed be entitled to the childcare hours and have more invested for their own future when their children have flown the nest. Another way to protect his money from tax and potentially build a nest egg for their future would be to open a junior ISA for each of his children. Any returns are free from tax, and even small contributions to have the potential to add up over time through compounding. Although bear in mind that any money invested belongs to the children for them to access when they turn 18. As Marco hasn't used his previous year's allowances in full, he could also potentially take advantage of pension carry forward, which would let him maximize the last 3 years of pension allowances too, just of course if he has contributed in fully to the existing year's allowance. He could pay anything left over into a general investment account with an aim to build wealth over the long term. While unlike an ISA, he will be subject to tax on any returns. With a capital gains tax allowance, any capital gains he makes are tax-free up to £3,000 each year. Like all taxpayers, Marco also benefits from an annual £500 dividend allowance.
Okay, so in our third scenario, we have Stuart. So Stuart's approaching retirement and he wants to support his family, retire early to spend more time with his many grandchildren, and move to the seaside where he and his partner have always dreamed of living. So he's built up his wealth over time by contributing to his ISAs and his workplace pension and saving hard. And he wants to make sure that he's doing all he can to boost his wealth before he stops working. Stuart could consider his workplace pensions and consolidating into a personal pension, potentially reducing his fees and giving him a clearer view of what he's on track for. Beforehand, he should always check to see that he won't lose any benefits or pay any unexpected charges. As a higher rate taxpayer, he can get 40% tax relief on his contributions, and maximizing his contributions while still earning a salary could be a big help down the line. He can use his gifting allowances too. For example, this year he could split up to £3,000 between his children or whoever he wants to gift, plus an extra £5,000 to his daughter as she's getting married. He can also give further gifts within the 7-year rule, which means gifts are free of inheritance tax if you live more than 7 years after you give them. If Stuart lives for less than 7 years after gifting, due to taper relief, inheritance tax would still be reduced, as it's done on a sliding scale reduction. For example, if he lived 3 years, the inheritance tax would lower to 32%, with an increasing reduction each year up to 0% at 7 years. In addition, he can also carry forward any unused annual exemption the next tax year, but this can only be done for 1 tax year. Stuart could also look to invest for income, as investment growth at Stuart's stage of life may be less of a priority for him. This would mean shifting his investments towards those likely to pay out dividends and provide him an income before he dips into his pension. Depending on his outgoings and how much he's invested, this could see him retiring early and using any income in combination with utilizing his ISA savings he's built up to help cover living expenses until his pension becomes available. Plus, he can also gift to his children through these income payouts. This is because while there are limits on the lump sums you can give away, there is more scope for tax-free gifts from income. There are rules around this, so we would recommend speaking to a tax advisor on this if you have questions. As he gets closer to retirement, Stuart may want to lower his risk level to make sure that his investments match his new goals and/or his risk appetite and time horizon. Getting financial advice about his pension drawdown can also be really important. Recommendations could include maximizing his income tax personal allowance before his state pension starts, or avoiding taxable withdrawals while he's still working. When considering ways to draw down his pension, he could look at flexible access pension drawdown, which give you options as to when you access your tax-free amount. The first 25% is tax-free, but it doesn't need to be used in one go. For example, you could take 5% and leave the remaining 20% in the pension to hopefully grow or to use at a later date.
Thanks, Stephen. So hopefully these scenarios have demonstrated how your allowances can work together, not just to be tax efficient, but also to help you achieve your goals and see how some strategies may apply to you and your family. Some of these strategies are more complex than others and require more planning. However, there are a few actions you can take today to help you get started. You can speak to our wealth experts for free for guidance on what you could do to achieve your own goals and maximize your wealth. Just scan the QR code on the screen below. Have a look at where you are currently. How much of your allowances do you currently have left, so you know what's available to you? Review your contributions into workplace and personal pensions. Pension allowances can be very impactful in achieving tax efficiency. Plan ahead for the 5th of the April deadline. Could you contribute more to your ISAs? Once it's the 6th of April, the allowance is reset, so do what you can do before then. Remember to prioritize the allowances which could benefit you the most. Of course, being efficient isn't just about tax. It's also about being time efficient and make informed decisions to fine-tune your wealth strategy. Have a discussion as a household where your investments and savings are. Do you know what you have and what your goals are? Are they currently set up for success, or could they be doing more for you? Financial advice can also be a powerful tool. So have a chat about whether or not that could be an option worthwhile exploring too. Consider other ways to drive cost efficiencies, such as consolidating your pensions and checking how much you're currently paying in management fees, for example. Remember, small steps can lead to a big benefit down the line.
Finally, it can also be a great time to think about whether you want to consolidate ISAs or pensions or products. We have a transfer offer at the moment that means you can get cash back or collect Avios when you transfer your existing ISAs and pensions to us. This is available for both new and existing investors, and you just need to register for the offering when transferring. If you're not yet an investor with us, we're also currently offering no management fees for 6 months. Just open an account and invest at least £500 by May 8th. There's no need to register or opt in. You can also take advantage of our transfer offer then at the same time. If you would like to find out more, as always, you can speak to our wealth experts by booking a call.
Great. So now we'd love to hear from yourselves. And so please do feel, as no doubt we've been receiving throughout the session, to send in your questions through the question box, and we'll do our best to get through as many responses as we can. But if you could just kindly, Charlotte, kick off with the first question, please.
Yeah, absolutely. So the first question that we've got is it better for me to contribute to an ISA or a pension?
Okay, I'll take this one. So I think it's fair to say that both have their advantages, and typically we'll encourage our investors to utilize both when possible. I think as much as anything else, it does, of course, depend on what stage the underlying investor is in terms of their investment cycle. So typically, for example, investors earlier on may indeed want access to their funds, at which point, of course, an ISA gives you that accessibility. Similarly speaking, if you're perhaps at the tail end of your working career, you might want to amplify, your pension contributions where possible, because of course, as soon as your earnings tail off, your ability to pay in your pension will do so similarly. So I think as much as anything else, it is about ascertaining your priorities, thinking about, tax efficiency, retirement purposes. So, in effect, it's really about, focusing what you're trying to achieve, where you are in your investment cycle, and making a conversation and with a financial planner, for example, which might indeed make things a bit more clear. But I think those are the sort of first steps that we would encourage our clients to look into. And then if, of course, they have any questions, they can always get in touch with ourselves to arrange a call just to clarify those next steps.
Thank you. We've got another one around pensions here. So does your personal pension allow me to pay in from my limited company?
Thanks, Charlotte. Yes, of course, our personal pension allows you to facilitate both contributions from your employer and indeed personal contributions. Often we have conversations with our clients in terms of ascertaining which is the best one to utilize. And of course, again, it's about prioritizing needs and objectives. Many investors, will make contributions from both designations throughout their working career. And of course, the different stages of that may indeed determine which avenue is more attractive than the other. But the flexibility of our platform allows you, to facilitate both.
Great, perfect. We've got a number around kind of ISAs. So can you open a stocks and shares ISA in addition to a cash ISA?
Yeah, it is possible to do that. And it is possible even to open multiple of the same type of ISA. So you can have multiple stocks and shares ISAs open in the same tax year. It's a good question actually, because it was the case that you could only open one of each type of ISA per tax year. I think they changed that in April 2024 actually to mean that you can have multiple of the same types of ISAs, of stocks and shares ISAs and cash ISAs. So yeah, you can absolutely have a cash ISA and a stocks and shares ISA open at the same time. And, we sometimes talk about that as a way to support different goals. We'd usually talk about your time frame. What are you looking for the product to do? If you've got a shorter time frame, cash can provide a bit of a solution. If you've got a longer time to support investing, well, stocks and shares can provide a solution in that case, provided you've got the risk appetite for that. The only thing I would say on that is that because the rules have relaxed a bit on the amount of ISAs you can open, and it's always been the case you can have a cash ISA and a stocks and shares ISA, it is still up to the investor to make sure that they are keeping track of their allowances. So, while you have multiple ISAs, it can be difficult to keep track of how much you've actually contributed to each ISA. the £20,000 still applies across your various products. For example, what we'll do in our platform is we'll allow you to adjust your allowance to make sure that you're not oversubscribing because we only have visibility on what you have with us. For example, if you have £10,000 you paid into a cash ISA in this tax year, what you can do with our platform is set your allowance to £10,000, meaning that if you're to go to £12,000 with us, we'll subscribe the first £10,000 and the next £2,000 we'll put into a general investment account, for example. So yeah, just to be aware that the £20,000 does still apply, even though you can have multiple per tax year.
Great, thank you. And then we've got a number of questions around kind of general investment accounts and the CGT exemption. So could Seb, you outline what a general investment account is? And then the second part of the question is, with general investment growth, is the tax-free up to £3,000 a year, regardless of your kind of tax status?
Sure. So when it comes to our general investment accounts, it effectively allows our clients to invest a greater sum than perhaps they would otherwise be able to do within their ISA. So once, of course, that ISA allowance at £20,000 a year is utilised, then of course one can explore, investing in a general investment account. It gives you a same level of flexibility, so you can apportion, different portions of money to different risk levels and strategies in a similar way that you can do within our stocks and shares ISA. But of course, the difference being fundamentally is you're not sheltered from tax. So, often that allows our clients to really have a plan, if you like, in terms of how to utilize a general investment account against that of their ISA. Some investors are going to be more attuned, if you like, to trying to reduce that CGT threshold, that allowance, as much as possible. So they might, of course, be mindful, if you like, taking on less risk within a general investment account to try and avoid driving gains. But indeed, what we provide for, as a matter of course, is a consolidated tax certificate. That's provided each and every year, which gives a very clear ability for clients, or indeed their tax advisors or accountants, to submit their tax return. So fundamentally, what you invest within a general investment account may indeed be taxable. Whether or not it's taxable or not, we would always suggest you confer, with a tax advisor if, of course, you're unsure. But ultimately, the gains, if they do exceed that £3,000 gain per year, are likely to incur tax liabilities. So, that's something which, as I say, some clients are going to be more mindful of than others. You could argue, obviously, it's symptomatic of a positive outcome. But of course, the general investment account does allow, clients to invest, as I say, sums greater than the ISA threshold.
Next question is really around lifetime ISAs. So is a lifetime ISA that can only be used for a first property up to 450k? And is the lifetime allowance of 4,000 per year still available even when I've used my stocks and shares ISA?
Yeah, good question. So that's a fair point. And I think, it's always worth looking into the terms and conditions of the lifetime ISA product if you are looking to use it for a first home. For example, it has to be used up to a home on the value of £450,000, as you've mentioned there. So that's something to bear in mind. And with all products, you need to look into the conditions and what they mean for you and how they can help you reach your outcome. So it's absolutely possible to have a lifetime ISA open at the same time as a stocks and shares ISA. You can have the two of them open at the same time. But I would just bear in mind the fact that they are part of your overall £20,000 allowance. So, for example, if you paid in £4,000 to your lifetime ISA, you could then pay in £16,000 to a combination of, let's say, a stocks and shares ISA or a cash ISA at the same time. Just bear in mind that you'd only have £16,000 remaining. You do still get a government bonus of £1,000 if you paid in £4,000 to your lifetime ISA, but you don't have to pay in the full £4,000 either. Regardless of what you pay in up to £4,000, you'd still be eligible for that government bonus on top of that. And the only other thing I'd say is, bearing in mind, it is possible to withdraw from a lifetime ISA, but typically what happens is you'll get a 25% penalty on your withdrawals as well. So typically for people who want to use it for a specific outcome, either later life or for using it for your first home, it can sometimes be useful there, but if it is the case that you need to withdraw, there will be a 25% penalty. So just bear that in mind as well.
I think just to add, and thanks for that, Stephen, I just mentioned that both, of course, are really tax efficient vehicles. They're really quite useful in terms of driving growth. But of course, what is true is they are slightly restrictive in terms of your accessibility, as we've mentioned, around lifetime ISAs. So if, of course, the rules around you utilizing the allowances, whether or not the purchase of the property is going to exceed that number, whether or not you're utilizing, for example, a conveyancer or solicitor to act for you in respect to the purchase. There are restrictions around utilizing lifetime ISA funds for a first home. So if those funds are not going to meet those requirements, then you're not going to access or be able to access them without incurring the penalty that Stephen mentioned until you're 60 years old. So again, this is perhaps a discussion around accessibility of funds, and also appreciating that if you're not going to take the hit, as it were, on that penalty, you won't be able to access the monies until, as I say, you're 60 years old. But being able to make contributions each and every year up until you're 50 with a 25% uplift is a very tax efficient way, again, of getting something back, if you like, from HMRC, to drive a better outcome over the long term.
Great, thanks, Seb. Next question. I've been a Nutmeg client for a number of years. What has changed since you've come JP Morgan Personal Investing?
So I think, it's fair to say that the business in lots of ways is very much the same. So principally, we are trying to drive positive investment decisions whereby clients, if you like, are leveraging upon our expertise to manage their portfolios for them. So I think the pillars around, as much as anything else, managing risk and doing so in a way which is not exposing our clients to unpalatable levels of volatility is something that we're very much keen to drive. So it's about driving sustainable returns over the long term. So in lots of ways, as I say, we haven't changed as a business. I think lots of clients have welcomed the acquisition. I think they feel more comfortable with utilizing our services in a fuller capacity. But ultimately, the principle is around getting clients access to our investment proposition at a price point that is much more aligned to their client interests is something which, as I say, remains unchanged. Would you add anything to that, Steve?
Yeah, definitely. And look, I'd say, one of the things about being, part of that and, kind of aligning with our parent companies, we get to launch different things. And there are a couple of things that we've been able to add to our offering, and it's very client driven. We like to be quite dynamic and respond to sort of client needs and meet more client needs when we can. And for example, one of the things we launched last year was income investing. And I think, it's just really allowed us to align more with what we're looking to do. So for example, another thing we're looking to launch as well would be a wealth planner tool as well coming soon. So there's different things that we've been allowed to do, as well as being quite relationship management focused as well. So, we do have relationship manager functions as well now for people investing above £250,000, for example. So, I guess, from our perspective, like Sebastian says, we've always had a particular focus and we're not looking to lose that, and we're not looking to detract from our core offering, which is, a discretionary solution managed by a team of experts, with a view to growing wealth and generating income over the long term for investors. But also it's allowed us to be a bit more dynamic and introduce new things for our clients as well.
Great, thank you. Next question is, I've already been paying into a stocks and shares ISA with another provider. Can I contribute to an ISA with you?
Yeah, sure. So yeah, absolutely. So you can definitely have multiple of the same type of ISA per tax year. So again, if you've opened a stocks and shares ISA with another provider, not to worry. Again, that rule was relaxed in April 2024, meaning you can now have multiple of the same type of ISA, same type of stocks and shares ISA, for example, in the same tax year. Again, just in particular, this sometimes catches people out, just the £20,000 to be aware of that. Sometimes what can happen is, for example, if you've got a direct debit set up or a monthly payment going into the ISA, it can be a bit more difficult to keep track of. So just to bear that in mind, and usually you can reach out to your ISA provider and confirm how much you've paid in the tax year. And what can also help you manage that is setting your allowance to a specific amount with your provider so that you don't exceed your £20,000 allowance, because it will be on the investor to make sure they're not going over that £20,000 across our multiple stocks and shares ISAs. But absolutely, you can contribute to two from different providers in the same tax year.
Thanks, Stephen. I would just add to that, in terms of our proposition here at JP Morgan Personal Investing, we of course specialize in stocks and shares ISAs. You could of course, look at opening a cash ISA if it's more suitable for your circumstances, etc. with that a chase, but we specialize in stocks and shares ISAs here. I just wanted to clarify that.
Great. And I think we've got time for one more question. So I recently opened a new business. Can I use pension allowances from previous years?
Yes, of course. And we have these conversations quite frequently with clients, entrepreneurs, what have you, that are starting companies in their early stages. often, it means to say that one isn't able necessarily to make substantial pension contributions when you're trying to start a new business. So revenues are often, directed in other areas. So, what you could, of course, think about doing in those circumstances is utilizing carry forward. Now, there are rules around the ability to utilize carry forward. You must, for example, have been a member of a UK registered pension scheme during the relevant years in question. And you must also have used the existing year's allowance, as I mentioned earlier, in full prior to starting to use previous year's allowances. But it's a very nice function, if you like, given the flexibility that those pension contributions allow investors to take, which of course isn't true, as we've mentioned, with advisors. So ISA allowances, they're either lost, utilised or lost, whereby, of course, pension allowances do give you that scope. As long as, of course, those limits and those rules are met, then, of course, you can utilise pension allowances through the carry forward function, which, of course, we facilitate here. So I think, that perhaps is us in terms of the webinar. We greatly appreciate your attendance today, and feel free, of course, to ask us anything that perhaps wasn't apparent or was a bit unclear just by booking a free call. Thank you, as I say, for your attendance today, and we look forward to helping you make more informed decisions around your wealth going forwards. Bye for now.